This video covers consolidation of debts in general with a particular focus on student loans. As you borrow money from more sources, for example credit cards, mortgages, student loans, etc., your liabilities become more difficult to manage. In some situations, consolidating your debts into one monthly payment may make it easier to manage those liabilities. Generally, debt consolidation is when you replace your many outstanding debts with a single new one. When you consolidate, you receive a new loan from a lender, which is then used to pay off all the old loans. This new loan can come from one of your old lenders or an entirely new one. The new loan is just like any other loan with an interest rate and repayment schedule. So, instead of paying several monthly payments for your debts, you only have one. Usually, the interest rate charged on the new loan is approximately equal to the average interest rate of all old loans. There are several issues to consider before determining whether or not it makes sense to consolidate your debt. First of all, if you can manage to pay your debts without consolidating them, the whole process may be moot. It is generally not advisable to consolidate for sheer convenience because it may involve paying extra fees to a debt consolidation service. Non-profit credit counseling organizations exist to help you manage your payments. If you elect to reach out to one, be sure that it is reputable and has few, if any, conflicts of interest. Beware, some organizations have a financial incentive to guide you to a specific option that may not actually be optimal for your situation. A good credit counseling organization can help you to prioritize repayments, create a workable payment schedule, and potentially negotiate more favorable terms with your lenders to help you manage payments. In the case of student loans, it's relatively uncommon to consolidate federal loans with private loans. The reason for this is in part because the government provides consolidation of federal loans for free, while private consolidation adds fees. As a result, borrowers may find it more economical to consolidate federal and private loans separately. Private lenders often require a credit check before consolidation. If your credit score is low, you may end up paying more after consolidation than you were paying before. If you have very little credit history, you may want to consider asking someone to co-sign the lease. However, remember that a co-signer is liable for the loan just as much as you are, and if you cannot pay, the lender will expect your co-signer to do so in your place. If you're interested in consolidation, you may also be interested in learning about deferment and forbearance policies. Deferment is the ability to suspend payments under certain specific circumstances. Not all situations qualify for deferment, but definitely do some research to see if your situation does qualify. If you do not qualify for deferment, you may be eligible for forbearance. Under forbearance, your monthly principal payments are suspended for up to 12 months. For both cases, interest on your loans still accrues. Nevertheless, under deferment, students with a subsidized loan may have interest paid off by the Department of Education.